Hello again. Okay, so in this video, I'm going to talk about the traditional versus Roth 401k and should you do a traditional to Roth conversion. So the traditional to Roth conversion can be a really valuable tax planning tool if you can do it strategically, or I should even say if the opportunity for you to do it strategically presents itself, because certain circumstances kind of have to exist. But just a little setup here, the basic gist is a traditional 401k versus Roth, same as an IRA. The traditional is such that you put the money in, you get a tax deduction for that deposit in the year you put it in. Your money can grow tax-free. Once you start taking withdrawals, you're taxed on the withdrawals as income. The Roth 401k is a non-tax deferred retirement account. So you put the money in today post-tax, meaning you make it, you pay tax, you put the money in. The money grows tax-free, but then later when you take the withdrawals, they are tax-free as well. So obviously you can see the difference there. They both have their advantages. Now, I generally go by the rule in your high income earning years, particularly if you're in a state with high income, like say California, where I used to live, if you end up in the 32% or plus, federal tax bracket, and then you're in the 8-9% state tax bracket, for every $1,000 you put into a traditional account, you're going to save $400 in tax because the deduction comes off, the top end of your income. If you're in younger years and you're just not making that much money, you might not actually get that much tax savings for putting the money in the account. So you might want to go with the Roth, let it grow tax-free, and then have tax-free withdrawals. So you can do the math every year on what your income is, what your taxes are going to be, and which of those two accounts to use. Now, in terms of converting it, this can be a very valuable thing. So say, for example, you put money in a high income earning year and you got that $400 per $1,000 savings, right? And say you put $10,000 in the account. You saved a lot of money because you were in a high tax bracket. Now, say, I don't know, you're getting, the next year you decide to take a sabbatical. I don't know, this is an extreme example, but you're not going to have any income, okay? You could make a certain amount of money with your personal standard deductions without paying any tax. So in that year, if you make no income, you could do a Roth conversion. You could take that $10,000 and move it into a Roth account. What happens is your 401k company gives you a 1099. It says, hey, he moved this money from a tax deferred account to a non-tax deferred account. He can do that. He can get the benefits of the Roth, but he's got to pay tax on the money as income now in this year. Well, in that year, you're not making any other money, and you have your whatever standard deduction, $15,000 or so. You can take that $10,000 of income tax-free in that year, do the conversion, and now you got a tax break when you put the money in, and you're not going to pay tax now on the withdrawals. In both cases, the money grows tax-free. So that's like the obvious, most extreme beneficial example. And in there, depending on your income and all these things, you might do a partial. I've done Roth conversions, like when my stocks were really down, in 2022. I was like, hey, let me do a Roth conversion. I'll pay some tax, but I don't have to sell the positions, and I think overall I'll do better, as the stock goes back up. So you could be very strategic about it. You just have to understand it. Of course, you want to, talk to your CPA. I'm not a licensed CPA, so any idea I have, I run by my CPA, and we collectively decide if it's a good idea. So certainly run any tax-related stuff or info I give you by your CPA. Thanks so much.